Okay, Chapter 3. Chapter 3, we're going to talk about the actual process of how stocks are traded. So let's have a basic overview. We're going to talk about how firms issue securities, and some of the processes and the terminology associated with that. Talk about some market types of transactions. And of course, we'll also include, since it's pretty important with trading, concepts of regulation, electronic trading, globalization of markets, etc. So let's get started with this chapter. So first of all, when stocks are issued, right? When they are first issued, in other words, a company decides they need some money and they're going to issue stock to gather the funds. So those shares have never been owned by a person. You can kind of think of this as the company selling the securities, but essentially the real correct terminology is issuing. So when securities are initially issued, then we refer to that transaction as having taken place in the primary market. The secondary market is any time the securities trade after the first time it trades. So obviously this is once an investor owns the securities and later on they decide they want to alter their portfolio. If they sell those securities to another person, that's what's referred to as a secondary market transaction. So if you think about companies in general, when they first start, they're rather small. So we have what we refer to as privately held firms. Typically, these are maybe less than 500 shareholders. Whatever shares they have very little liquidity. They don't have a market to trade in. The companies have fewer obligations as far as financial statements. And as I mentioned, some of these are very small. They might be family-owned businesses, but they are corporations. So they have a high amount of business risk, and they need limited amounts of liability, so they may want to issue stock in order to expand operations. Publicly traded companies then are obviously those that trade to us, the investors, the public. And we already mentioned, right, when public offerings are marketed by underwriters, this is typically done in what we refer to as the primary market. This is where we have an initial public offering. It's the first issue of stock to the general public. And then we also have what's referred to as a seasoned equity offering. In this case, it's an older company. So say Procter & Gamble wanted to issue some new shares to raise some money. We would refer to this as a seasoned equity offering. Regardless of the name, these shares have to be, or these issues have to be registered with the SEC. So there is a process that the company has to go through in order for these shares to get to the public. Now, one of the things that we need to understand is that corporations don't have any personnel who really are familiar with the current market, pricing, the actual distribution of shares, etc. So the issuing firm is typically going to hire an underwriter. An underwriter is a person that is essentially a middleman. They are the marketing people for this security. Now, what the lead underwriter is going to do is they're going to find some other people to help them distribute these shares. So imagine, a company has $200 million worth of shares to distribute. One company might find that rather difficult to do. But if I can split that up by, $20 or $30 million per investment company, we can then spread that out a little bit and take some of the risk away from the initial lead underwriter, if you will. Now, frequently what companies will do is they will keep some shares sort of like in the inventory. So they'll be able to issue these on relatively short notice, typically in smaller amounts. And the cost of this distribution is going to be a lot less than what it might be for a full-blown entire issue of securities. So again, this allows companies to maybe bleed out some of the shares over time, so they don't have a large increase in cash and ownership right away. We mentioned an initial public offering. Again, what happens in this process is there's going to be some type of a presentation. They're going to call it a roadshow. They're going to go on the road, talk to investors and clients, and try to describe to them the benefits of this particular security. What they're trying to do is develop interest in the security. Now, they can't take any orders yet. In fact, we don't even know what the price is going to be until actual registration day. So, again, we're going to try to get a feel for the demand for the stocks, so we'll have an idea of maybe what price to offer the shares at. The underwriter, as I mentioned, is the person that bears the price risk. Remember, they need to distribute all of these shares. If the company needs $100 million, they're going to issue $100 million in stock. The underwriter gives the corporation the $100 million up front. They then are in charge of distributing those shares. So what happens if the shares don't sell well? What happens if there's less demand than what they actually thought? Or in some cases, as I mentioned here, for Facebook, the underwriters vastly overpriced Facebook when it was initially issued, and the issue didn't totally distribute. So again, there's the risk in this case is often taken by the investment bankers, and they are obviously worried about being able to get rid of all of the shares that they have. So, how are securities traded, right? We can do things in several different ways. There's something referred to as a direct search. This essentially is where the buyers and sellers of securities seek each other out. This is, you could probably imagine this might be done between friends maybe, but in the broad market, there's probably very little of this direct search that actually is fruitful with respect to buying and selling securities. Most of the trades are going to happen through what are referred to as brokered markets or dealer markets. And those broker and dealer markets may or may not take place in what's referred to as an auction market. In a brokered market, the broker is searching out buyers and sellers, especially out there, they're contacting their clients to try to get them to either sell shares that they have or buy shares that the brokerage firm may have in inventory, if you will. The dealer market, basically the dealer market is where, you think of that kind of being like a retail store, where you're going to go and you're going to look at the inventory on the shelf, and then you're either going to buy that inventory or offer to sell that inventory to the dealer. The auction market is where the traders actually converge in one place to trade. The New York Stock Exchange is such a place. So it is an auction market. In the next slide here, what we have is there are two videos. I'm not going to play them here, but I suggest you pause your video here and watch these videos. The first video is from YouTube, and it is a video about the New York Stock Exchange trading floor. So you learn a little bit about how that action works or how that activity works. The second one reflects the activity that takes place at the commodities market, at the Chicago Board of Trade. So both of those are auction markets, but they are vastly different kinds of markets. So I think you'll find those videos kind of interesting to see what goes on actually on the floor. So let's talk about prices before we get too far into the types of orders. There are two prices that we need to be aware of. Both of them are published in Yahoo Finance. Every day you can find out the bid and ask price of stocks. The bid prices are offers to buy. So in a dealer market, the bid price is the price at which the dealer is willing to buy the stock. So if the dealer is buying the stock, this is like they are buying inventory to sell later. So the bid price essentially is a wholesale price. So if you sell your stock, you are typically selling it at the bid price. The ask price is the exact opposite. It relates to the retail price. This is what you have to pay when you want to buy the security. This bid-ask spread is the profit that the brokerage house gets for the security. Now, this bid-ask spread is not fixed. The riskier the stock, the less liquid the stock, the greater this spread is going to be, because it's harder for the brokerage firm to sell those things that are very risky or have some low financial strength, etc. So this bid-ask spread will change depending on the kind of company and the stock it has. It can also be dependent on how much of a particular stock you're buying in volume. So the bid-ask spread might be lower if you were buying 10,000 shares than if you were buying 1,000 shares. In addition, it might also be different based on the actual market value. So, if you're buying $100 worth of stocks versus $1,000 worth of stock, again, this bid-ask spread can change relative to that process. Stocks are typically bought and sold in a 100-share increment. It's what's referred to as a round lot. So when you buy stock, if you buy at a round lot, you will probably get the smallest bid-ask spread for that kind of stock, for that volume, etc. But if you only wanted to buy two shares, then the bid-ask spread might be larger because the company has to break up the lots. So here's essentially how this works. If you go to a company and they say, well, I want to buy 100 shares of P&G. If they have 100 shares of P&G on the shelf, they sell you those 100 shares. But what if they don't have P&G on stock? Now they have to go out and buy to fill your order, and they have to buy the 100 shares. But they must always buy in 100 share increments. So if you only want 2 shares and they don't have any of that stock, then they're going to have to go out and buy 100 shares to fill your 2-share order. That's going to obviously cause some problems with getting rid of the other 98 shares. So they'll charge frequently a higher spread if you buy a mixed lot or an odd lot rather than a round lot. So there are essentially 2 kinds of orders. There are market orders and there are price contingent orders. So a market order is executed immediately, and whatever the price is, that's the price it's executed at. So if you call up, you say, hey, I want you to buy 100 shares of P&G, whatever the price of P&G is at that instant in the market, that's the price that you're ultimately going to pay for those shares. Now, you can also create what are referred to as price contingent orders. In other words, you can tell them to act, but only act if it goes to a certain price. So, for instance, you might say, look, I want you to buy P&G stock, buy 1,000 shares if P&G stock goes to $150. So when it gets to $150, that's when the trade is going to occur, right? So that's essentially the two different types of orders. But if you think about these price contingent orders, they have different ways of kind of looking at them, right? So let's look at the condition. You have a price. Let's say that the price that you're interested in is $100. If you want to buy the stock, right, at a price that's below the limit, so you want to buy the stock at 95, you would place what's referred to as a limit buy order. So it would only buy the stock if it fell to $95. You would create a stop buy order. Quite frankly, this might be if we'll talk about them in a couple of minutes, you have a short sale, you're actually going to lose money if the stock price goes up. You would place a stop buy order to save yourself, save some profits, if you will. That would be the price contingent order. And of course, the exact opposite would be true. You would do a stop loss order if you were selling a stock and it was below the limit, and you would do a limit sell order if the price again was above the limit. So again, the terminology probably isn't all that important, just so that you understand that there are certain kinds of terms that are used for these different transactions. Again, a dealer market acts like a retail store. You can actually even trade or do a transaction through an electronic communication network. Trades are going to happen automatically, right? So you can do this on the internet through another type of a broker. There's a person that works in the stock market, though, that's referred to as a specialist. And this specialist is a person that maintains a fair and orderly market. So when you watch the video about the New York Stock Exchange, he goes and buys this stock at the one and only place on the New York Stock Exchange floor where that stock trades. So when you have these electronic tablets, if you will, somebody says, hey, go buy 100 shares of this stock, then what you do is you need to know where to go to buy it. So if you look on it, it will have a location, so it'll tell you where to go. That company, that entity that owns that spot, if you will, I believe in the video it's Goldman Sachs, that company is what's going to be referred to as a specialist. They create and bring together the supply and demand market for that particular stock. So there is some new information, not new information, just a new world, if you will, with respect to electronic trading. It's becoming more and more popular. So in the United States in the 2000s, the share of electronic trading grew from 16% to 80%. So there's a huge growth in this electronic trading. We've had some emergence of different markets. We've had markets that are now merging together. So now historically, the difference between stocks was, or a stock price, is stock prices were said to move in a tick. Well, a tick was an eighth of a dollar, or 12.5 cents. Now it's a 16th. So again, now when you see stock prices move now in pennies rather than in larger denominations, if you will. And this is just a function of so many trades happening that it created the need for these smaller increments of trading and markets and the metric, if you will, of understanding how things trade. So again, let's kind of look at the markets in general. The New York Stock Exchange is the largest stock exchange, right? There's several parts to this. Most recently, they've merged with the American Exchange. So the American Exchange itself doesn't exist anymore. but there are some pieces. There are fully automated execution for some small orders. Specialists can handle large orders, right? They obviously help keep the pace, keep the market working and moving forward. The Nasdaq is really more of a computerized network. It's not really a place. There are about 3,000 firms in this market. Quite frankly, almost every brokerage firm belongs to the Nasdaq. But essentially what this is, it's a network that connects all of the brokerage houses and therefore all of their inventory for all of the shares. It puts it all in one place. So at any one time, if somebody goes into a brokerage house and wants to buy shares, that broker can instantly look and say, well, where can I buy those shares the cheapest for this client and get them the best, lowest price to buy? And of course, they can do the exact opposite with a sell. So it enables them to search the market a little bit more and to try to understand and provide the best pricing, if you will, for the shareholders. ECNs are these electronic networks, right? Typically, they're a private network that links buyers and sellers, right? They compete in terms of speed, right? So these things can act very, very quickly. And there's lots of them, right? There's the thing called the Direct Edge, BATS, New York Stock Exchange, ARCA. But essentially what you're looking for with these electronic networks is you want the transaction to happen very quickly. And this type of a network minimizes the time lag between making the offer and actually delivering on the transaction. So that's part 1 of chapter 3.